Oh, it's
Hey,
brighter.
Happy New
Happy
Year,
New
buddy.
Year to you.
You know, I want to congratulate you for getting your stuff out on CNBC lately, and nice little breakthrough for you. And it's been really top shelf stuff that you've said on there. You were there for the turning point. I just want to give our viewers the backstory before we look ahead. One day I sent Andy a video. I was still bearish euro looking for 102. He said, I disagree. And that was the low. And the euro never got to 102. Euro started advancing. And then one day I'm, cruising through my house and I look at CNBC and Andy's there. I'm not sure what the event was, Andy, if it was the mixture of treasuries. That may have been the day, and then there was another day. It may have been a CPI number. But basically, your message was buy all assets, quote unquote. Okay.
Yeah.
And that was an excellent call. Bonds had a huge rally, dollar headed lower, S&Ps rally. And they asked you about S&Ps. And you said, well, 44, maybe 4,500. Did new all-time highs surprise you, or did it evolve into being able to see that coming?
Yeah, so let me just briefly mention that. So last summer on July 31st, I was also on CNBC and gave a heads up on what the quarterly refunding announcement was going to look like and what it meant for assets. And my view at that time was sell bonds, sell stocks.
Yeah,
That played out beautifully, with both of them going down 10 to 15%. And
right,
then on Halloween, Janet Yellen reversed some of the pressure on the bond market, and that
right.
caused the low. And that's when you saw the buy all assets. Unfortunately, it's gone too far, much farther than I expected. And actually, by the end of the month, I was short assets again, and now I'm getting squeezed a little bit on the stocks, though the bonds have more than come back from the peak. And so, what's interesting is on next Wednesday, you have another quarterly refunding announcement and an FOMC meeting. And with assets up here, both bonds and stocks, bonds are still not cheap. Um, you could have a reversal depending on what plays out.
Okay, so TLT, I saw it down here too. I was looking for 92 to 94, so I mean it blew
Yeah.
away my expectations. And we've had a little bit of a pullback, but halfway back would be about 90, 61, around 89. So are you expecting this to be just a correction of this advance, or is it going to take out the lows? And is your expectation that after a pullback, we could have another wave like this later on? Another,
Yeah, so I think we could be choppy. I would say one thing, which seems to be what you've said as well. Um, Markets have gone from one extreme to another fairly rapidly over the last 2 years.
yeah,
And to me, the moves have been from a point of extreme irrationality to the opposite side of irrationality,
yeah.
in which you get these incredible moves. And I think we're in the midst of another one. And I don't have a low estimate for treasury bonds. If we continue to see this economy do what, it is ironic that Citi is now calling for an economy.
Yeah.
I saw that
Oh,
on your,
yeah.
yeah, of course that's ironic, but
It's
um,
like Barron's.
when it comes to the economy, I've been higher for longer than anybody, and still stick around with my view. It hasn't really changed at all. That the economy, both the real economy and likely the stickiness of inflation, will last a long time. And so that favors stocks over bonds, but it certainly is negative. At a minimum, it's negative for bonds. And I think the bigger step back one has to do when thinking about the bond market is recognize that the Treasury has significantly increased the proportion of bills they have outstanding
Right.
as a portion of the debt, and that won't last. And so what will happen over time is, well, number one, unfortunately, there seems no political will from either party, and certainly when there's gridlock, neither party, um, both parties,
To
to
cut
reduce the
spending.
deficit.
Yeah,
And so, and whether it's, a Republican view that you should cut taxes or a Democrat view that you should increase spending, both of them are deficit increasers. And
right.
even in the event of a unified House, Senate, and presidency in 2025, whichever way that plays, deficits aren't coming down, they're staying high. So a combination of significant amount of front run bills issuance and large continued deficits means that the duration of the private sector's treasury ownership is going to extend, and markets aren't priced for that sort of extension on TLT here. So you can't be a and so when I think about that, I think what's normal. And currently, one measure of the value of a long-term treasury is in the term premium, and it's currently negative 15, negative 20 basis points. And in non-QE periods, forget QT, in non-QE periods, term premiums are, 125 basis points. And, that's 145 basis points from here. And to me, that's just
Fair
the
value.
it's just fair. That's fair. And maybe we stay above fair for a long time. But if you take 100 and let's say 100 basis points and add it on to treasury yields, TLT is below the lows. It's trading with a 5.5% yield instead of a 4.5% yield. And so
Okay.
I don't think you can buy long-term treasuries because there's so much coming and so little the private sector seems to want treasuries. You got an inverted yield curve, well, or flattish yield curve, assuming what's priced in terms of Fed cuts, which I think is also extreme. But you've got particularly given the economy is so strong, but you got a flattish yield curve that doesn't create a lot of incentive to buy long-term bonds. They're rich from a term premium standpoint. And so, a year from now, I would expect the term premium to have expanded by 100 basis points. And that alone puts a 20% price headwind to TLT. Now, do I think it's
Okay.
going to go down 20%? It depends. If the economy keeps pace with what it's been doing, yes, I do think it'll be down 20%. If we have a recession, maybe down only 5 or 10% because, growth and inflation will continue to fall. But then stocks are going to get crushed. They're going to go down 20 to 30%. So, that's my long-term outlook. As it relates to what happens, in the next week or two, it'll all depend on the news that I just described in terms of the quarterly refunding. And Janet Yellen has a choice. She can either increase, she has really only one choice. She can either it's not three options. She really has only two options. She can keep coupons about the same, or she can significantly increase the coupons that she's issuing. And you have to say, well, if she significantly increases the near-term coupons, it's probably going to be a negative for bonds. And maybe you test that 90 price on TLT, which is my
Yeah.
expectation.
Okay.
But if she doesn't load bonds in this next quarterly refunding announcement, the question is, what's the upside? And because she's going to have to over the next 2 to 3 years, regardless of who's in the administration. And so it's just tough for me to run against that headwind.
Okay. Luke Roman has mentioned that bonds are trading like Banana Republic because they're risk on, risk off now, and they're not risk. They're not when there's risk on. The market could still rally and the bonds come off, but this is what really fueled it. And you explained to me that there wasn't going to be a flight to quality rally in bonds, I don't know, about 6 months ago. And for the market to have trouble, you needed a bear market in bonds. Are we still in that stage? Are we getting closer to where if the economy weakens, the bonds could do okay and hold?
Well,
And
as I said, I think that, when I talked to you about that was in July. And,
Right.
we had the things that would have played out for a script for a recession for stocks down to, 82 on
Yeah.
TLT. And then Janet decided to delay the recession.
Okay. All
And
right.
now she bought herself another 3 months. And you can see that in the incredible rally in both stocks and bonds. That's why I went buy all assets. The question is going forward, can she keep delaying the inevitability of a recession, which will start with higher bond yields, long-term
Right.
bond yields, and
Okay.
then result in lower multiples, and then result in lower demand by the wealth effect, and then cause stock earnings to fall, and finally cause,
Bonds
job
to rep.
losses. Unemployment rate still is extremely strong.
Yeah.
GDP is still, well above target. And inflation's come down a lot, which is great. But the Fed has sort of, as of December, unleashed animal spirits regarding, future cuts in the of the Fed funds rate using this real interest rate Taylor rule based idea. And financial conditions have exploded easier. And
Okay.
so, we've started to see some pushback from the Fed, but the data, they can push back all they want until you start seeing the inflation data firm. That doesn't have to go pop back up. No one's expecting that without a supply chain disruption. But until you start to see it firm, people are just going to take the Fed and ignore them until they're forced to act. And that really comes in March. And in March, they're not going to do anything in January. We know that. They're going to talk about QT. Maybe it gets slowed or paused or whatever. And, that's an important issue. But mostly the Fed is all talk in January, and the market is pricing a 50% chance of a cut in March, and we'll get a new SEP plot in March. So I think the Fed is mostly off the page for the next 3 months and if data warms on the inflation front, you're going to get a real bad reaction in 2 years in 2 year notes.
Okay. So in March, I believe that emergency facility that they put in for when the regional banks failed, that could end then too, unless, it was for an emergency. It doesn't look like there's an emergency anymore. Would
Yeah, the
that have any
BTFP
impact?
program. The
Yes.
BTFP program, they it ends on March 11th. And
Okay.
ending is an interesting word. Usually when people think of ending, they think the Fed is going to force the banks to pay them back. But based on the terms, and you just have to look at A.5 and D.6 in the document, turns out anybody in the program as of March 10th of this year can extend another year. So that whole thing is, to me, completely moot.
Okay.
That there is no March 11th BTFP event whatsoever.
Got it.
And the only thing that'll happen, and also, if you noticed last week, they mentioned the mandatory requirement to use/test your use of the discount window. The discount window existed and could have solved the problem that the BTFP addressed back in a year ago in March. But there was a stigma associated with participating at the discount window. And so they thought they'd create a new program, which also had modestly better terms to ease the problem. I think they're just going to a regime in which the discount window is their emergency thing and trying to eliminate the stigma. And so I think that's the development on emergency programs going
Okay.
forward. But we'll see.
Thanks for clarifying that. I know you keep an eye on the dollar, Andy. You have any view? Has it changed? Wouldn't Is it possible that G, when he came to San Francisco, was talking about the state of his economy and having to intervene to support the yuan, and was maybe asking for some relief on a strong dollar with like a weaker one, and the rest of the world would benefit from a weaker dollar, wouldn't it?
Yeah, I mean, the way I think of currencies is obviously it's relative conditions, and the
The
relative
yields.
conditions in the United States have been led by the Fed more than any of that stuff. And the relative conditions have weakened, and the dollar has at least begun to, and this is sort of since Janet in October, and then
Right.
through till the peak in um, where is that?
It
Jan, I
was
guess,
only a couple
late
weeks
December.
ago. Yeah.
You got all that coming from the Fed, saying we're done, and all that rally. All that rally in the dollar. Sorry, where are we?
Euro. This is the euro.
Yeah, okay, right. So all that sell-off in the dollar, strength in the euro, is because the euro has been stayed steady regarding its policy expectations, and the US has gone full dove. And so that weakened the dollar. And it makes sense to me that it weakened the dollar. And now you're starting to see the walk back, the talk. We had 175 basis points of cuts priced in December 2024. At that peak, and now we only have 130, 135. That's a big move, and it's important in the dollar. Do you mind if I share the screen briefly? Do you think I
Oh,
can?
no. Sure, go ahead.
Let me see if I have this chart.
So I'm thinking you're looking for the dollar to continue to strengthen a little bit with bond yields going back down.
Yeah, really, no.
Bot TLT going down. Yeah.
So really, look at this chart. This is my favorite provider of currency flow information, the folks at State Street. And what they do is they look at every single position. They're one of the biggest global custodians of assets on Earth. Top two, I think, maybe number one. And this is their clients. And right now, if you look at this chart, what it says is, are the holdings in each currency overweight or underweight? And that's the y-axis. And on the
Okay.
x-axis, you have whether they're buying on the right or selling on the left. And so what you see in the dollar is pretty darn rare, which is equal weight, neutral buying and selling. And I think that's about right for the dollar. Now, there's some anomalies out there, like the euro to me looks oversold and underweight. And so I'd be real cautious based on this alone, being short the euro here. And, other currencies you can see, but nothing besides the euro and maybe the Aussie are in a vulnerable territory to me. So anyway, I like this. And what it says to me is what the macro is telling me, which is that the US dollar is going to be volatile regarding the relative easing and tightening. And if the Fed does in fact go as fast as the market is priced in terms of cuts, the dollar's likely to get weaker. And longer term, the issuance and the deficit and all of the things that we just talked about at the beginning are bearish dollar. But, right now, nothing looks to me to be actionable because of both the technical levels to the
Yeah.
extent that watch that, and
Yeah.
the positioning relatively balanced, and the pushback that's happening on the short end.
Yeah, I
So
think the
I wouldn't say I
pushback
have a big dollar view.
may give us a buying opportunity in euro around 107 is kind of a technical area I'm
I
eyeballing.
think euros, I think my next trade will be long euro. I'm just not sure where.
Okay. Andy, how about metals? I know you trade gold. So, your call for being long all assets to me right now feels like you've shifted to the other side as they correct from the huge rallies they had. So, are you negative gold right now or neutral? Because
Right now
silver's
I
been
have
getting hammered.
right
Silver's been
now I have
getting
a
hammered.
I'm short a little bit of gold in my alpha portfolio. Just as a reminder, I also always have a beta portfolio that's long gold. So I guess short term, I'm bearish gold, but not very much.
Okay.
All in all, I'd say it's okay, but it's one of many assets. And I think that based on the quarterly refunding on next Wednesday, assets, including gold, either go up or down based on what the decision is.
Do you have any comment? Do you follow the miners at all?
I don't. I do have
Okay,
a
you're
colleague
lucky.
that does.
Jimmy?
I just set up a partnership with Shy Girl,
Oh,
who's on
Tracy.
Twitter,
Yeah.
and she and
Okay.
I now have a collaborative effort called DS Shy Girl that's dealing with commodities, and Jimmy
Right.
Jude as well, that deals
Yeah.
with commodities and where we obviously focus on metals and producers, miners, etc.
Because they're
Right now, I think
testing
the
2
only
or
thing that
3 year lows,
right, the
the
only thing that we've
mines.
looked at that we sort of like right now, where we got long oil, not at the lows, but in here. And we just recently recommended a small junior uranium miner of all things.
Oh,
But
yeah.
that's really Tracy's job. I don't know. I just
Yeah.
keep her in the macro framework I use to deal with those things.
All right. Well, another great addition to your team. I've talked to Tracy many times over the years. And Andy, I want to thank you for, coming in here every quarter or so and edifying us and giving us really crystallizing what's happening with bonds and how it affects all the other asset classes. And just appreciate your contribution to edifying our community. I want to thank you.
I appreciate being here. It's a great
Uh,
opportunity.
and the best place to follow you is on X is just at
At Damp
your
Spring.
yeah.
And
You have a website?
dampspring.com if you're interested in working with me in other ways.
Okay, cool. All right. Andy Constan, everybody. Follow Andy at Damp Spring. And if your ideas are fuzzy, read Andy's work. It's going to be an asset to you. It'll crystallize things, and he does it in a way that even I can understand.
Dale, thanks.
All right, buddy. Andy Constance, everybody. Enjoy the rest of your day, folks. You could join the group in 20 minutes, a team. And don't just count your pips, count your blessings. I'll see you guys tomorrow. Adios.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.